Hi guys, welcome again to Fit Rich Sane. I know all of us want to be healthy, wealthy, and wise. I am Aditya, and I bring to you people who are true experts on the topics that we love. You can listen to them live, and you can ask them your questions right here. To find out about the next live episode in advance, you can follow me on Telegram at Fit Rich Sane. As a community, we believe in action. And that is why we will simplify knowledge and processes for you, bringing them down to small, actionable steps that you can take today. Today's esteemed guest, Basavraj Tonagati, who is actually better known as Basu Nivesh, is a SEBI registered investment advisor practicing the fee only financial planning service. He is a certified financial planner since 2011. How we all know him is through his personal finance blog, Basu Nivesh, which is rated by almost everyone as among the top finance blogs in India. He has spent over 15 years in this industry and has over 500 happy clients while having written over 1,000 personal finance articles. While I was researching about him, I was amazed to see that even companies like Kotak Mahindra, Max like Kuvera, and a few others cite his writings as references on their websites. By the end of today's live podcast, we will dive into the depth of where you should park your money for the short term, and we will also discuss several nuances about indexing, including how to invest in the index, which index to invest in, equal weighted funds, and a few other aspects. Thank you everyone for joining in and for making these live podcasts fun and useful. Let's become peaceful and happy investors with Basavraj Tonagati. Basavraj, did I miss anything that you want to tell us
I
about
think,
yourselves?
yeah. In fact, you mentioned more than what I used to hear. Thank you for giving me this opportunity, and it is obviously a great opportunity for me to share whatever the little I know about personal finance.
I'm sure we learn a lot. So I'll start with my first question. So
Sure.
we'll start a discussion with investments for the short term, right? Now,
Mhm.
the various options that I can think of that are there in the market today are corporate FDs, bank FDs, small finance bank FDs, debt mutual funds, and arbitrage funds. Now,
Mhm.
till a few one financial year back, debt mutual
Mhm.
funds used to have a clear advantage in terms of taxation.
Correct.
But with that being leveled, which one of these do you think is the best suited fund for people that might need their money back in a few months or a couple of years?
Yeah, obviously. See, when you are investing, or else I may use the word called parking, when especially it is a
Right.
short-term requirement, then obviously the first thing we have to look for is the safety of the money. So in that case, uh, if your requirement is just within a few months, then I think the overnight funds or else liquid funds are far superior. However, if you know well when you need the money, take for example, after 1 year, you need to fund for your kids' education. If you know definitely, then you can explore the corporate FDs or else bank FDs also based on your risk appetite. But if your requirement is more than 1 year, then obviously you can explore certain debt funds like ultra short term debt fund or money market fund. I'm suggesting the debt funds, even though the taxation is same in current scenario, mainly because if you look into the feature of FD and these debt funds, obviously because of the tedious concept in FDs, they may not turn attractive if your holding period is more than 1 year. So for that reason, if your holding period is more than 1 year or so, I think it will be better you park it through the ultra short term or money market kind of instruments. If it is less than 1 year, either you can use the bank FDs, liquid fund, or else overnight funds.
Okay, so it is entirely dependent on the duration for which we need to park.
Correct, correct, correct. When I say short term, for few, it may be few days or few months or let's say few years
Absolutely.
also. For that reason, based on our requirement, we have to choose which is the best product.
Okay, and following up on the same question, what about funds like your emergency fund where you want the fund liquid enough, but then you also want some decent return because you might even not need it for many years?
Yeah. See, when it comes to emergency fund, what I usually used to suggest that, see, two things matters a lot when you are parking your emergency fund. Again, I am not using the word investment specifically here. I am using the word parking.
Right.
So two
Absolutely.
things matters to me. The first one is how fastly I can withdraw the money even in case of emergency. Take for example, we may we may face an emergency even in midnight also, right? So
Very
the
true.
liquidity should be at highest priority. The second thing is how safe it should be. In that sense, I think the simple bank FDs is far, far superior in current scenario rather than looking at the debt funds or else some other kind of opportunities. Because even though, take for example, in case of a liquid funds, many of us think that as the name itself is a liquid, I can get the accessibility at any point of time. However, if you need the money instantly, you can't get it instantly. You have to wait for 1 or 2 days, especially if your requirement is more than 50,000 rupees. So for that reason, for parking the emergency fund, I think bank FD by splitting equal to your monthly expenses is a simple strategy. You can use it to manage your emergency.
Okay, so that's great. For your emergency fund, primarily because of the liquidity aspect, we can settle for bank FDs. And
Correct.
for the benefit of everybody listening, could you just repeat for me what you said you said that short-term funds should be parked according to the timeline after which you will need them. But you mentioned a very good breakup of less than 1 year, around 1 year, and more than 1 year. Could you please repeat that for us?
Yeah. See, let me give you an example based on, that will give the clarity to the listeners. Let us say
Perfect.
you want to spend a certain amount of money on travel, but you are unsure of in which month actually it will happen. Maybe in 3, 4 months or after the 6 months it may happen, but you are unsure of. In such a
Right.
situation, you can use a simple liquid fund, or else within 1 or 2 months you are spending on certain interior kind of expenses or trying to buy certain electronic gadgets, but you are unsure of when you need the money. During that point of time, you can use the overnight fund, which are completely safe. However, if you are sure of when you need the money, then simply you can use the bank FDs. But as I told you earlier, if the requirement is more than 1 year, then I think better to explore the ultra short-term debt fund or else these money market funds.
Perfect. Thank you. Thank you so much for that answer. I think that covers the entire investment aspect of short-term parking your funds. Uh, Now, next, I have one question about health insurance. So,
Mhm.
just some basic tips from you how we can make sure our insurance claims are smooth. And the second part of the same question is, in case a claim gets rejected, what can we do about it?
Okay. See, there is no such a standard formula which we can say that, okay, by following this one, I will be in a best health insurance or else I may having a best health insurance. But certain things I will try to point it out so that that can be beneficial for the listener. The first point is there should not be any room rent cap. The second one is there should not be any co-payment kind of a thing. And the health insurance must cover all the daycare treatments, because if you look into the way how the medical field advanced earlier, for the
Right.
diseases which may require around 1 to 2 days of hospitalization now can be treated in a daycare. So for that reason you have to look for covering all the daycare treatments also. And don't choose any deductible, especially if you are buying the base policy, not the super topper. And fourth and important aspect, what I will suggest is that check for the network hospitals of that particular company, because that will be more handy, especially in case of emergency. Try to find if the network hospital is available nearby you. But again, I am trying to point out here that I think many are unaware of this recent change, what happened in case of a health insurance. See, General Insurance Council recently, maybe around 4 to 5 months back, they notified one thing that irrespective of whether your hospital will be covering under the network hospital or not, they have to settle the cashless claim only. The only condition what
Wow.
they put forth is that if it is a planned hospitalization, then you must inform the insurance company 24 hours prior to the hospitalization. If it is unplanned hospitalization, then you must inform the health insurance company within the 24 hours of the hospitalization. So I think network hospital criteria to check whether it is nearby or not, I think it is not a bigger criteria now. But how they will implement this new rule is unknown to me. But this is how the General Insurance Council recently notified it. So obviously, all the claims from now onward will be cashless only. And check the waiting period for the pre-existing diseases. If you have any pre-existing diseases, then obviously you have to check it out whether they are put forthing any particular conditions for your existing diseases. And always buy both the base and super top plan from the same company. That will be handy for you in claim settlement. So these are the major points you have to look for when you are buying a health insurance. And apart from that, the major thing what you have to look for is you have to disclose the facts properly. Don't hide anything, especially if you have any issues with respect to the health, and make sure that no matter whether they will increase the premium or not, or else they may outrightly reject the policy also, that is secondary. But from your side, disclosing the facts is very, very important, and knowing which are covered and which are not covered. Many people have a misconception that if I have a health insurance, the insurance company must cover all the expenses. It is not like that. There are certain exclusions also, which you must read it out when they will issue a bond, and by looking at the policy document, you will come to know all those exclusions. So you must have a clarity about which are excluded and which are included. That will give more clarity for you.
That's fantastic. I think you have given an amazing list. Just if you could answer the second part of the question, that if a claim gets rejected, is there anything we can do about it if we feel we have been wronged?
Yeah. See, whether it is ABC company or XYZ company, they're all into the business. Obviously, they will try to
Absolutely.
find the loopholes when the claim will be there. So the
Right.
first thing, as I told you, when you are buying the policy, you must disclose all the facts properly. First thing. Second thing, whenever there is a rejection, don't be emotional saying that, okay, this policy rejected and this company is bad, or don't brand it like that. Because there are various reasons for the claim rejection. There are various reasons for the hospitalization also. So we can't
True.
brand just because my claim is rejected, the whole company is good or bad, right? So first thing, you have to avoid the emotional part of this situation. The second thing what you have to look for is you have to find the reasons for the rejection of the. I mean, obviously they will provide the reasons, so you have to try to read the details why they rejected the claim. That matters a lot. Then you have to check it out the policy wordings whether the hospitalization related exclusions is actually listed in a bond or not. If it is covered, then obviously the health insurance company must accept it. If it is not, then obviously your fight may be fertile. So for that reason, try to understand, don't be emotional, understand the reasons for the rejection, then look into the policy wordings properly by looking at the whole policy bond. And if they are at a wrong side, then immediately approach the company's grievance. It doesn't mean that they rejected means I have to accept it blindly. In each company, there is a grievance cell. First, you have to approach them, say that my policy is rejected because of this reason, which is wrong as per my knowledge. So I am raising the complaint. So first level of a grievance is at company level only. If you are not satisfied with whatever the responses they provide, then you can approach the ombudsman. This is
Okay.
a simple process what you have to follow. But obviously, as I told you, there are various reasons or rejections. So you have to find it out your own way by looking at the first thing what many of us will look, as I'm stressing again and again, is that once a policy is issued, try to read whole policy document. That will give more clarity about which is included and which is not. Then you can take a call.
I think this is a very good point. People often miss out reading the document and they become so emotional, as you said, that, yeah, as you mentioned, some people start criticizing the company. But I'm sure you have also seen people criticizing health insurance as a concept altogether, just because their claims got rejected. So, yes, it's important to keep a level head at that time and to understand. And yes, even then, if we feel that we have been wronged, of course, you give the perfect solution. We can correct me if I'm wrong, we can approach the grievance cell of the company and then the ombudsman.
Correct.
Right? Perfect. So, Basuraj, moving on to the other type of insurance, general insurance and the life insurance. So I think you'll agree that most insurance policies today are missold,
Mhm.
especially the ones with some returns, like endowment plans, ULIPs. Whether they are
Mhm.
good or not is a different topic, but mostly to the investors, they are definitely missold. Now,
Mhm.
the problem is that even if one realizes that a policy that we are holding today, whether it was sold by a relative or whether we didn't know better at that time, even if we
Mhm.
realize that the policy is not good for us, we don't know how we can get out and if we can get out of it at all. Now, I
Mhm.
understand that you also have some experience working as an LIC agent from around 20 odd years back.
Mhm.
So, with that, could you please guide us how we can exit policies that aren't helping us financially any longer?
Yeah, definitely. So when it comes to traditional plans, obviously, to be eligible to close or else or to get the paid up value or surrender value, the policy must run at least for 3 years. But in case of a
Okay.
ULIP, it is almost around 5 years. So if you find it very difficult that to digest the product itself is a wrongly sold to you or missold to you, then after 3 years of completion, in case of a traditional policies, uh, especially if it is in the initial phase of a policy, then obviously I think it will be better for you if you opt for a paid up in the sense the policy will get lapsed, and whatever the premium you paid along with the bonus will be converted into certain paid up value, and a certain portion of that paid up value you will get it immediately. And if the policy is
Okay.
more than half of a tenure, take for example, in case of a 20-year policy, if you already completed more than 10 years, then I think converting the paid up is I mean, best choice. But again, it depends on what type of a policy and how much is the paid up value and or surrender value. All those things we have to check it out. Then we have to come to the conclusion. But if you opt for a surrender, obviously, to certain extent, in many cases, in fact, there is a loss. So usually I will suggest to convert it to paid up value. Now, in case of a ULIP, obviously, if your policy completed more than 5 years, then you can stop the premium payment and you can close it at any point of time. Whatever the market value is there, that one you will get it immediately. So that will be a handy information with respect to the ULIP, not about the traditional plans.
Okay. Just one follow-up question on that. What exactly happens when we convert a policy to paid up?
See, as I told you, paid up in the sense you're stopping the premium payment and you are indirectly saying to the insurance companies that no, I am in no way paying the premium. So policy will be lapsed. Whatever they will calculate certain based on their formula, they will calculate certain valuation of the amount whatever you paid. I mean, based on the sum
Okay.
assured and bonus accrued and the premium you paid and the tenure of the policy, that paid up value you will get it at maturity.
Okay. Okay. So we have stopped paying the premiums today, but the value that is applicable, we get it at the original maturity of the policy.
Correct. 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 Correct.
And this is mostly possible for any policy that has completed 3 years.
Yeah, it can be possible for all the traditional policies which are completed more than 3 years.
Okay, that's wonderful because I think most people take many, many years to realize that the policies that they have aren't helping them. As you can understand, most people end up buying from relatives and very early in their careers, only to pay premiums for decades on end with hardly any returns. So yes, if they can stop paying the premiums after 3 years, that's absolutely amazing to know.
Yeah, obviously.
Right. So, as you know, the main topics we are now going to discuss is index funds and various tiny nuances related to them. Now, so Basavaraj, when we discuss index funds or indexing or investing in the index, investing in the market, what I think all of them are similar terms. There are two primary ways to invest that I understand: ETFs and index mutual funds. Now,
Mhm.
according to you, is one better than the other for retail investors?
See, obviously, those who are looking for an index funds, their main idea is to look for the low cost. So, if you consider the low cost only, obviously, people will try to divert towards the ETF, but they ignore the other
Yeah.
factors which are related to ETF. It is not like a typical mutual fund where you buy and the units will be awarded to you. And one fine day, if you don't want, then obviously you can approach the mutual fund companies to sell it off and they will give back the money. It is not like that. In case of a ETF, as you may be aware, they are listed in a secondary market. Obviously, you have to buy and sell like a typical stock, right? So
Right.
the NAV what they publish is entirely different than the price which will be available when you are buying and selling. And again, it depends on the demand and supply. So for that reason, if you know how ETF works, then explore the ETF, not because just of a low cost, but try to understand how the variations will be, especially during the volatility of the market. Let me give an example. During this Lok Sabha election of 2024, when I checked the Nifty Bs with respect to the Nifty,
Mm.
Nifty was down a lot compared to the Nifty Bs, mainly because of a demand and supply. So what I'm trying to highlight here is that even though Nifty may be down or up, you may not realize the same opportunity of a down and up when you invest in a ETF because it is mainly dependent on the demand and supply. Okay. And
Right.
especially during the market crackdown or else the market is going down and if you want to sell it off, then if the volumes are not so high, then you are end up in selling than the actual requirement of yours. So for that reason, you have to be very cautious in choosing the ETF. And in case of an index fund, obviously to certain extent, the cost is little bit higher than the ETF, but you will completely run away from this risk of market related buying and selling of what the ETF is. So in Indian context, even though cost effectiveness is there in ETF, I will suggest you to explore the index funds as of now because market is not so big and we are not explored so many ETFs in case of an Indian context. So as of now, I think it will be better if you stick on to the index funds rather than the ETFs.
Okay, so as of now, you're saying that even though ETFs might cost you lesser,
Hmm.
but index funds have much more liquidity, which can help normal investors.
Correct.
Perfect. So, Vasavraj, when we talk about index funds or ETFs, there are three prime terms that keep coming up again and again. One is tracking error, second is tracking difference, and third is TER, or the total expense ratio. Could you
Hmm.
please throw some light on these three terms?
Surely. I will explain you in simple because I don't want to go into
Thank you.
technicalities of all these three terms, but in simple way, I will explain you.
Absolutely.
Tracking
Perfect.
error in the sense how much the fund is volatile with respect to the index. I mean, you may in simple way say that the standard deviation of the index fund with respect to the index. If it is tracking error is high, it indicates that it is volatile, more volatile than the index. This is in simple way we can explain about the tracking error. Now the tracking difference means the returns of the index with respect to the returns of the fund. The return difference between these two is called as a tracking difference. So again, higher the difference means obviously you will end up in earning lesser than the index. So obviously you have to look for the fund which may have a lesser tracking difference. And the expense ratio, obviously it is total expense ratio. You have to look for the lowest one, especially you are looking for. But at the same time, I'm not saying that just because of the lower expense ratio, don't choose the funds because it may be a trap in future for you. Currently, they may be offering you at lower expense ratio, and in future, if they increase the expense ratio, then obviously you have no choice to but to continue with the same fund, or else you have to move to some other fund. Again, it will cost you. So for that reason, total
Right.
expense ratio to an extent you can ignore, but concentrate on tracking error and tracking difference.
Okay, so even though most investors just blindly look for the lowest expenses, that might not be the best idea.
Correct.
Because
Tracking
at a later
again,
date,
expense
if you
ratio.
have to switch, the taxability will also be there.
Correct. And expense ratio obviously matters, but don't consider too seriously because in many cases, especially in index funds in Indian context only, I can give many examples where they started with a low expense ratio and slowly when the AUM grows, obviously they will increase the expense ratio. Then afterwards, people will be kind of in a trap, right?
Hmm.
For that reason,
Right.
don't look for the index fund which has a track record of not doing such a deviation in expense ratio.
That is a very good point. Okay, so diving a little deeper, so if we are going for a index mutual fund, Now, if we have two funds that track the same index, how is there any particular criteria of using which we can choose which one we should invest in?
Yeah, as I told you, the first thing you have to look for is all these tracking error and tracking difference, which is now mandatory for all the index funds in India. They have to publish it. Just look at
Okay.
the fund which is having a lower tracking error and tracking difference. And the second important aspect is obviously to certain extent the expense ratio. But as I told you, the fund must have a track record of not deviating or not changing too much with respect to the expense ratio. That you have to look for. And third important aspect you have to look for is a decent AUM. Decent AUM in the sense there is no such a standard mark that, okay, if this much is there, then it is a decent and not like that. But at least around 200 to 300 crore of AUM is a decent AUM. So that the fund manager can manage the inflow and outflow in a better way, especially during the volatility. So for that reason, these three pointers are main things you have to look for when you are choosing the index system, like tracking error, tracking difference, and expense ratio, and then to certain extent the AUM.
Okay, great. And similarly, if there are two ETFs that are tracking the same index, how do we choose between them?
Again, the same thing, but at the same time, you have to certain extent look for the volume of a trade. If volume is high with respect to particular ETF, then that will be better for you to look into it rather than just looking at a tracking error and tracking difference. Because one day
Okay.
or another day you have to sell it off, and at that point of time, if there are no buyers, then obviously it will create a huge differentiator for you. So along with all these factors, whichever I mentioned with respect to index funds, you have to look for the volume of a trade of that particular ETF. That can be an added point you have to look for when you are choosing the ETF.
Okay, fantastic, fantastic. So it's index for index funds, basically a low tracking error and tracking difference along with a for mostly constant expense ratio and a high AUM. And we're choosing an ETF, the same factors plus a good volume.
Correct, correct, correct.
Perfect. That solves a lot of doubts. Now, when we talk about investing, we are obviously talking about investing in the market. So, keeping that in mind, would you suggest that your clients or other investors invest in Nifty 50 or 100 or Nifty 500 or some other index?
Hmm. See, again, if you look into Nifty 100, okay,
Right.
you notice that major chunk is in Nifty 50, okay,
Very
and
true.
around 20 25 percentage or less than 30 percentage in Nifty Next 50. So in that context, the combination of Nifty 50 or Nifty Next 50 in your own terms based on your risk appetite is far superior than having a Nifty 100. Now coming back to the Nifty 500, if you look into the construction of a Nifty 500, obviously again as it's a market cap weighted index, the major check
Mm.
is towards the Nifty 100 only. Okay, even though you
Right.
can add another 400 or 450 stocks also, it hardly matters. Just the numbers will be added. But in terms of a overall percentage, it hardly matters. So for that reason, I think Nifty 100 is far superior. And within the Nifty 100, Nifty 50, Nifty Next 50, based on your risk appetite, is enough to manage the whole market rather than exploring yourself with a Nifty 500 or something like that.
Okay, so for most investors, Nifty 100 shows more than enough.
Enough, enough. If you want to explore beyond that one, then you can add a Nifty Mid Cap 150 index also. Beyond that,
Okay.
I don't think there's a need.
Okay, fantastic. Now, as you mentioned, that these funds are mostly market cap weighted. So, again, would you also, first of all, could you explain what are market cap weighted funds and equal weighted funds? And then, if you could tell us which one do you think are more advantages?
Yeah, definitely. See, market cap weighted index in the sense, let me explain you in simple way, like in a Nifty 50, it
Right.
is the top 50 stocks of the Indian market. How they arrive at the number one, number two position is based on the number of stocks available in the market multiplied by the current price. If that number is the toppest, I mean the highest one, then the company will form with the number one position. Take for example in Nifty 50, before the merger of HDFC Bank with HDFC Home Loan, Reliance was the number one position. Now after the merger of HDFC Bank with HDFC Loan, then obviously now the number one position is by HDFC Bank.
Right.
So based on that one, the number of stocks available multiplied by the market price, the position will be arrived at like a 1, 2, 3, 4 like that up to 50, Nifty 50, 51 to 100 in the Nifty Next 50,
Right.
and afterwards the mid cap like that they will arrive at, and this will be changed once in a 6 months by the NSE, and accordingly these index funds and ETFs also replicate that one. Now with respect to the
Right.
weighted average investments, equal weighted especially, all the stocks, take for example in case of a Nifty 50, around the top 10 stocks may be having an exposure of 60 to 70% because of their market
Right.
cap. But in case of a equal weight, it will be equally distributed among all the top 50 stocks of the Nifty 50. So again, by having a equal exposure of all the stocks, in some cases, the risk will be reduced. In other cases, the risk will increase. Let me give you an example. If you compare the Nifty 50 with the Nifty Next 50, okay, so
Right.
in case of Nifty 50, as I told you, in case of market cap weighted index, the major 10, 50 stocks will be having a higher exposure. Now, when you compare that one with the Nifty 50 equal weight, then obviously it will be spread among all the top 50 stocks, so risk will reduce. Now, we can't assume that the same thing will happen with the other equal weighted index also. Let me give an example. In case of a Nifty 100, Nifty 100 in the sense major chunk is in Nifty 50 and minor chunk is in Nifty Next 50. But if you choose a Nifty 100 of equal weight, then obviously you will end up in taking a higher risk than the Nifty 50 or Nifty Next 50 because the exposure will be increased to the Nifty Next 50 stocks also. In the same way, in case of a Nifty 500 and Nifty 500 equal weight, as I mentioned earlier, in case of a Nifty 500, major chunk is Nifty 100. So obviously that will give major stability to the index.
Right.
Minor portion is among the remaining 400 stocks. But in Nifty 500 equal weight, if it all distributed among the large cap, mid cap, and small cap, it will pose a huge risk compared to the Nifty typical 500. So what you have to look for is when you are choosing, don't assume that equal weight will reduce the risk. It will not. It depends on what type of an index you are choosing. In some cases, it will reduce the risk. In some cases, it may increase the risk. And again, in case of an example of a Nifty 50 market cap weighted index to equal weight index, in many times, even though risk is reduced, you have to bear the underperformance with the Nifty 50 because of the risk is reduced. So these things you have to look for, and don't try to generalize the things that, okay, market weighted index is little bit concentrated risk and equal weighted risk index will actually spread your risk. It is not like that. It depends on what index you are choosing.
Okay, so what I understand is that with market weighted funds, the risk is that there is higher concentration in a single company. But in equal weighted funds, the risk comes that there is no single company with a very high concentration, but the investment in smaller companies is much higher, which would be lower in the market weighted fund.
No, it is not like that. What I am trying to say is that within that index, equally they will spread in terms of
Right.
equal weighted. But in
Equal
case
weighted,
of
right.
we can't say that risk will get spread. It is not like that. Only the proportion of the holding will be equally distributed among the these stocks. But in
Companies,
case of
right.
market cap, obviously the risk may increase or decrease depends on what type of a index you're choosing.
So just to take an example, if somebody wants to invest in Nifty 50 itself, which one would you suggest and why?
See, as I told you earlier, if you want to reduce the risk, then equal weight will be far better than the Nifty 50 normal weighted index
Okay.
because there it will be spread equally. But if you're choosing the Nifty 100, then the normal Nifty 100 will be less risky than the equal weight of a Nifty 100.
Makes sense. Makes sense. Great. Okay, so I think that wraps our discussion about index funds. Now, I have a few rapid fire questions for you. And although they're meant to be rapid fire, but if you think that some particular question deserves a bigger answer to help the investors, we can, of course, do that. Okay, so my first rapid fire question is: should we try to repay home loans early, or is it best to let them play out through the tenure?
Okay, it again, let me explain you in detail because many people have a misconception about this home loan concept. Now,
Right.
for God's sake, don't retain a home loan just for the tax saving purpose. Especially many salaried will do this matters. Okay,
Right.
what they think is that under Section 24B, if I pay the 2 lakh interest to the banker, then obviously I will get the additional tax benefit. Don't do that
Right.
one. If you think logically, there is no tax benefit. Rather than that, if you can't afford the home purchase, then you can go for a home loan and retain it if you don't have a home. I mean, you don't have a money. But for tax saving purpose, don't retain the home loan. First thing. Second, whether you have to repay the loan or not, it again depends on how old the loan is. Take for example, if the loan is just new one, like within less than 4 or 5 years, then you have to concentrate on repay it aggressively. However, if the loan is almost around 5 years or 10 years or more than 5 years or 10 years and it's already in the verge of a closure, then obviously I don't think there's any need for you to rush for the loan closure. Second
Okay.
point. Third point, when I say home loan is a short, I mean, just the new one and you have to pay it aggressively, it doesn't mean that you have to ignore your other financial goal. Take, for example, you have to invest your mandatory goals like kids' education and marriage. Along with that one, if you still have a surplus, that surplus should be diverted towards a loan repayment. But don't sacrifice those major goals and try to repay it everything here. This is the second point. Third one, what many people do is that, take for example, if the home loan interest is around 8 to 9% in current scenario, they try to explore the avenues where the returns may be more than 8 to 9% so that they will get the arbitrage opportunity to earn something. But we are unsure of whether we will get that opportunity or not continuously fixed in a fixed term. So for that reason, don't explore such an arbitrage opportunity also. If your goal, I mean, if your home loan is less than 5 years or short term, I mean, recently started, then obviously it will be better to repay it by managing your mandatory goals also. If your loan is the older one, I don't think there is any rush for you to prepay it immediately.
Got it. So it basically, if it's older, you have already paid most of the interest part as it is. So there's
Correct.
no point of fighting to repay it. And if it's in the first few years, then it also depends on your other financial goals and plans and investments.
Correct. 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 Correct.
Great. Okay, so next, where do you stand on the renting versus buying a house debate?
It is a common thing and
Yeah.
highly debatable. But at the same time, I want to say you few things. I mean, the pointers. See, many real estate investors don't have a clarity about why they are buying the property. If the property you are buying is for your personal usage, then you must set different criteria for that. However, if you are buying a property for investment purpose, then you have to look as if an investor. Now, let us first discuss about the uh, buying a property for own usage or as a commodity. Now, when you are buying a property for your own usage where you are going to stay there, then obviously you have to look for the ambience and you have to look for the comfort and also the affordability. You will not look for the price appreciation because if the price appreciate, then obviously you will not sell that one and move to somewhere else, right? You are
Right.
going to stay there. And again, if the house you are purchasing is not affordable for you, then go for a loan and it again different story. But if you are buying a property for an investment purpose, then you have to look as if an investor rather than having a emotional attachment to the real estate. So the first thing is
Makes sense.
to check it out whether you have that much of money to buy the property or not. In many cases, especially in Indian context, People doesn't have that much of money, but they want to buy a property by hook or crook if the kind of a attachment with them. So obviously they will borrow the money. And when you borrow the money as an investment, borrowing the money to investment is obviously a wrong thing. But if you still want to go ahead, then there should be an arbitrage opportunity, right? Take, for example, the borrowing cost is around 8%. And I am sure that the investment where I am doing in real estate is obviously generate around 9%. So obviously 1% arbitrage is there means you can explore. But many people doesn't have this clarity, right? And again, as it is an asset class, you have to look for how much percentage of that buying will be in within your asset class. Take, for example, when I say net worth, you have to exclude your personal assets like your car, jewelry, and the property where you're staying. After excluding all these assets, whatever the amount left out, if that is forming around 100 rupee, just for the diversification purpose, we can explore around 10 to 20% in real estate. But don't overgo yourself to the single asset class, especially in case of real estate, because it is a highly liquid and the returns are not so great. So be cautious when you are exploring the real estate as an investment. That also from borrowing the money.
I love the last part that it has to be a part of your investment overall portfolio as a part of diversification. Because what we mostly see is that people accumulate through financial investments like mutual funds and stocks, and the moment they have enough to buy real estate, they sell everything and buy one single property.
Correct. Because no matter whatever we say, we as an Indians have a firm belief that gold and real estate will never fall.
Well, which is not very true, but
Correct.
let's hope awareness increases with time. Okay. So now we talked about real estate, talking about equity. Now, over the last few years, it is not even news anymore that the market forms a new high every day. Almost every day, every week, there is a new high. Even if there is a crash for 1 or 2 days, I wouldn't even call it a crash actually. Even if there's a small fall, that is considered a crash. And even then, the recovery is so fast. So, what should be the game plan for investors when the equity market is at an all-time high?
Yeah. See, when you are investing in equity, the first thing you have to look for is why you are investing. So when I am asking why you are investing, you must have a clarity about your goals, financial goals, especially. Take, for example, kids' education or retirement or short-term goals, medium-term goals, or whatever it is. So
Right.
if you have a clarity that, okay, I am entering into the equity market only for my long-term goals, then the next thing you have to do is to diversify your investment among debt, gold, or equity. So
Right.
as a diversified approach, you must have a entry into the equity market because we don't know when the market will fall and when the market will goes up. Because if you especially check it out the history of the last 100 years,
Right.
it is not up to the Indian context, but the global context. What I'm trying to say is that uh, there were around 24 to 25 market crashes. So on an average, we can say that once in 4 or 5 years, the market crashed.
Right.
And the average time taken to come back from all those market crashes is around 2.5 to 3 years. The biggest one was during the
Okay.
Great Depression, where it might have taken around 16 years. And the lowest one, maybe during the COVID period, within a few months, it came back. So we must have a strategy. If such a fall there, then how I have to sail through and how I can manage the risk. So for that reason,
Right.
enter into the equity market only for your long-term goals, and that also with a proper asset allocation rather than relying on a single asset class like equity, especially by looking at the last 4 or 5 years of a market uptrend.
Got it. So, even though the investments in equity should be maintained for the longer term, but it's also important that your portfolio is diversified and
Correct.
the amount for short-term goals can be withdrawn.
Correct. And again, whether you, me, or someone else, we don't know when the market will fall. Obviously, we all know that market
Right.
is touching all-time high every day, but at the same time,
Right.
we don't know when it will fall. In
Right.
that
Fall. Right.
situation, obviously, having such a calls is very much important, and mentally prepare that if you are investing, then it should be for the long term, and part of your portfolio should be there, and mentally prepare yourself that if there is a downtrend of around 30 to 40% over a period of 1 or 2 years also, it must not impact your financial goals and your financial life.
Perfect. Right, right, perfect. Okay, so I have another subjective question for you. Now we know that you are a fee-only financial planner, so what the investor buys ultimately does not impact you at all. So if a
Mhm.
client comes to you and tells you that they want to attain fire at the earliest, what do you tell them?
See, we all looking for a fire. It is not like a
Right,
particular sector or a particular age group or a particular industry people. But at the same
right,
time, to achieve the fire, you must have 2 to 3 things in common. The first one is you might have received a huge surplus from your family so that you can enjoy your life without working. First thing. Second thing,
true.
you must start investing immediately when you start earning, because achieving the
Hmm.
fire is not like a magic number or else you can do it instantly or else there is any solution for that. You need to be very, conservative in your spending, at the same time aggressive investing over decades of a time. Okay. And third thing,
Right.
be patient about what you are doing. Let me give an example. I used to give this example to all my clients, so I will share that one with you. During the COVID period, I got one client who is almost around 49-year-old, and he lost his job because of the COVID. He approached
Okay.
me to look into his portfolio, whether he can sustain his retirement and he can fund it his kids' education or not. See,
Right.
even he is not a graduate, and he used to work in one mechanical company in Pune.
Right.
When I looked into his portfolio, what I found is that he can easily fund his kid education and he can easily fund his retirement goal, and he left out with another 1.25 crore.
Wow. Wow.
So, so what he did is, what I noticed is that from the start of his earning till 49 years of age, he invested blindly without looking into what society will think about his life.
Amazing.
Maybe certain good thing or bad thing happened when he chosen the product and all those stuff, that I streamlined. But at the same time, what
Right.
matters a lot is when you are creating a wealth. The whole wealth creation
Hmm.
journey depends on a compounding formula. In that one,
Hmm.
only two things matters to us. One is how much I invest and how long I wait. Return is not under our control. That guy followed that one over 2 to 3 decades. So when his colleagues asked him what he will do at 49 because COVID is there and no one may intake you as a employee, then his answer to his colleagues is that, see, I plan to retire at 50 and I am retiring at 49. That 1 year is only the surprise to me. So
Wow.
what I'm trying to say is that wealth creation or else achieving the fire is not like a instant thing. You have to sacrifice a lot in today's term to enjoy the fruits in the later term. Be conscientious or else try to follow the interest, avoiding the instant gratification and all the stuff. Invest rigorously as if there is no tomorrow, but wait as if a decade is there for your holding, and try to, I mean, invest over a decade, 1 or decade, 2 decades with a huge income by living within your means. That will obviously create a fire, and it can be easily achievable.
So I think I have a very similar opinion about this that out of the fire, the RE, the retire early is optional. That is up to an individual. But the FI, the financial independence, is something everybody must aim for because, as happened to the client in your example, at 49, he had nothing else that he could fall back upon.
Correct.
But
And at the same time,
just as, right.
yeah, tell me, tell me.
I was just saying that even at 49, he had nothing else to fall back upon. But just because he had been saving so religiously and happily, he didn't have any financial worries at least.
Correct, correct. And at the same time, see, when you have a stable income every month, like a salary, dreaming about fire is entirely different than when you actually depend on your assets to generate the monthly income. First thing you have to look
Right.
for, because there will be up and down, so you have to be mentally prepared for that. The second aspect is many of these guys who are exploring the fire, they don't have a plan of what they do it when they achieve it. Because for a human being, sitting idle is the biggest challenge, right? So you
Absolutely.
must have a
Absolutely.
clear You must have a clear picture about what you will do once you achieve fire. I'm sure that you'll not sit idle. There may be certain income range, but you don't want to depend on that one for
Right.
your livelihood. But trying to do something and have a clear cut plan, even if you achieve the fire also.
Absolutely, absolutely. I completely echo your thoughts. Now, after the lovely discussion about fire, my last rapid fire question to you, and I think it will again help everyone, is there an easy way to, or in fact, what way do you recommend to manage banking passwords, details of assets, and other financial information for yourself as well as for your family?
Maybe a few months back, I wrote in one article how I manage my financial details. I will share the same thing with you.
Definitely.
I have an Excel sheet where in first sheet I put all the username and passwords, and in the second
Yep.
sheet, as I have only around two goals in the second sheet, I have emergency related information like where my emergency I have kept it, and health insurance related, life insurance related, and accidental insurance related policy documents and PPM and all those stuff will be there. I mean, it's a kind of a emergency sheet, I can say. In the third sheet, it's about my daughter education goal and her marriage goal, where I'm investing
Okay.
and what is the value and all those stuff. In the fourth sheet, it is about retirement. So what I did is that just for the security purpose, I am not sure whether I am perfect or not because I am not a technical guy, but this is what I am following. I put the password for that Excel sheet and I am keeping that one in a Google sheet. And
Okay.
my wife knows where that can be accessible. And along with that one, once in a quarter, I will send this Excel sheet to my brother and my wife through the email so that even if they can't access in emergency, I mean, yeah, immediately they
Right.
can refer the last email and they can assess certain details
Okay.
like
Right.
insurance, term life insurance, and the investment details. So this is where I'm managing. And again, it's a kind of a Excel sheet is password protected, and the Google Drive itself is two-factor authentication. So I think this will be easier for all of us to manage. But I am personally uncomfortable with keeping the data and using the apps and all those stuff because one way or another way they try to assess our personal details, which I don't want. Rather than
Absolutely.
that, this simple Excel sheet customizing based on your requirement is enough for you to manage your personal details.
Perfect. Perfect. Thank you so much. I'm sure this will help everyone. Now, Basavraj, I have a final two questions for you. And these two questions are same for all our guests. Uh, so the penultimate question is for people who are listening to you for the first time. As we discussed in the beginning, I would like to call ourselves a very action-based community because there's so many people who watch so many YouTube videos, read so many blogs, and at the end of the day do nothing. They just procrastinate the action decision.
Mhm.
So, for people listening to it for the first time, please suggest one small actionable step that they can take today itself to become slightly more peaceful and better investors. Now, you can target this to investors either who are just starting out or who have some investments but they're absolutely haphazard and there is no plan around it.
Yeah, definitely. See, nowadays, because of this social media and all those stuffs, we have a huge number of information already available with a click of button. But
Right.
trying to differentiate between what is the information and knowledge is the biggest challenge for us. So for that reason, try to follow the information diet as much as possible. Because if you
Lovely.
follow the simple strategy of identifying the goal, doing the set allocation and set up the system, afterwards you no need to look into the financial news and noise every day. Okay, you just have to invest regularly over a decade of time. Maybe once in a year review is enough for you. Beyond that one, I don't think you have to look for regularly to the information and all those stuff. And at the same time, second point, what I try to look here is that you can learn a lot by looking at the history, especially related to finance. Because no matter how much we grown up in terms of knowledge, information, and managing our money, end of the day, we are all humans. So when there is a panic, when there is a greed, when there is a fear, obviously we act in the same way like how our ancestors were, worked or acted during all the market crashes. So if possible, try to read the history, especially related to finance. That will give more insight rather than looking at the current events and all those stuff. And again, I want to highlight you one information that See, when you look into the any news or noise, try to ask yourself after 1 year or after 5 years or for your financial goals, which may be around 10 years or 20 years away, how it is going to impact this current news. If it is not going
Lovely
to
point.
impact, ignore it, no matter whatever maybe it is. Take, for example, many people will create a huge noise around these election results or else RBI policies
Right.
or these budgets and all those stuff. But it hardly matters a lot. Let me give a classic example. During 2018, when the late finance minister Arun Jaitley introduced long-term capital gain for the equity market, during that point of a time, people reacted in such a way that equities end for a Indian market. But if you look into current scenario, obviously, how many of us aware of that event, right? So these are part
Right.
and parcel. Like, you no need to react all these stuff. Try to read the history books. The more you read about the history, the more you will try to understand. And the major change in your investment journey is how you control your behavior. Just concentrate on that.
True.
Ignore all these noise. Invest aggressively. These are the points which I will suggest you.
I think that covers everything that an investor needs to learn while starting the investment journey. That the diet should be, the information should be as little as possible. You have to go on an information diet, and as you said, news may be important for traders, but for investors, not so much. Uh, Now, my last question for you: people who are looking forward to learn more from you, what is the best way?
Uh,
Any-
usually, yeah. I'm usually active on social media like Twitter, Facebook, and I have a WhatsApp channel also where I will publish the thoughtful idea, not about the news and noise, about the thoughtful
Right.
ideas, whatever I will get it while interacting with the clients, whatever they did the mistakes, I will try to convert that into correction point and I will try to share the status and all those stuff. You can follow that. Along with that one, as you earlier told, I have a blog where I write articles, at least around 8 articles per month. So you can refer
Wow.
there also the insight. And I'm not saying that you follow me only. There are other people also who are more knowledgeable than me. So, as I told you, try to follow those guys who will try to share the knowledge unbiased without, having a attachment with the products or trying to sell something on you. Those
That is
you can
important.
do it on your own because the idea or else the knowledge should be unbiased as much as possible. This way you
Absolutely.
can read and you can learn from my side also.
And I'm assuming on all these social media channels, you'll be available with the handle Basu Nivesh.
Yeah, yeah.
Perfect. Yeah, Basavrat, it has been a pleasure having you here, and thank you for taking out almost an hour for us. In
My pleasure.
particular, if I have to point out, I love the answer you gave to where people should invest for the short term. You gave a very detailed answer and very precise answer for that. Other tips you gave for health insurance will definitely help people avoid getting their claims rejected. And one thing that most index, even hardcore index investors don't understand very comfortably is which index fund or which ETF they should go for. It's still easy to select the index, but within the index, which index fund should go, they should go for, which ETF they should go for, whether they should go for an index fund or an ETF. These things are don't come very naturally to most people. And finally, I absolutely loved your answer to the question about whether people should repay their home loans or not, because it took into account the entire financial plan, not just that question. Uh,
Thank you.
so, anyway, thank you so much for being here. And thank you so much to the audience also for being here and spending an hour with us. For more episodes, you can always follow me on Fitlet Same at Twitter and Telegram. And again, thank you so much for being here.